The expected normalization of global central bank rates by the end of 2024 will be conducive to credits overall. As such, we think duration will continue to perform well in 2024. Clarity on the US Federal Reserve and other central banks' interest rate trajectory will determine the pace, depth, and volatility of the repricing of interest rates. Hello, welcome to another RHB Treasury podcast. I'm Chris Tan, Fixed Income Strategist at RHB Banking Group. Looking back at the fixed income market in 2023 so far, global bonds have returned 1.88% so far, as persistent inflation in the developed world led to volatile interest outlook. Fortunately for Malaysia, fixed income assets performed on par with historical averages due to moderating inflation and stable OPR. The changing interest outlook this year led to volatile yield movements. On a year-to-date basis, global, US, and Thailand government yields rose while yields on Indonesia and Singapore fell. Malaysian government and corporate bond yields fell substantially, which contributed to positive fixed income returns. The two main return components in fixed income investment is the return from coupon and return from bond price. For Malaysian government bonds, coupon returns remain the main contributor to returns on a year-to-date basis with a return of 3.78%, while the change in bond price contributed 1.68% return. In terms of non-resident bond holdings or foreign investors, non-resident flows into Malaysia government bonds continue to increase at a healthy pace. In November 2023, we saw 5.6 billion ringgit of net non-resident inflows, bringing in a year-to-date net inflow of 29.7 billion into Malaysian government bonds. Comparing the non-resident holdings in government bonds, Malaysia has one of the highest non-resident holdings in US dollar terms, followed by Indonesia, Thailand, and Philippines. The current high interest rate environment in the US is a new phenomenon since the global financial crisis in 2007. The elevated US Treasury versus Malaysia government bond yield spreads coincided with the increased correlation between the MYR and Malaysian government yields. As such, a softening US dollar yield outlook should support a lower yield structure for Malaysia. So, what's in store for 2024? We think global rates will continue to trend lower in 2024 on the back of continued moderation of global inflation. Supply chains continue to normalize and cross-border labor mobility has improved, easing worker shortages and backlogs. Nevertheless, the road to historical inflation rates will likely be a bumpy road as we continue to see reflation risk, and risk remains on the pathway to Federal Reserve 2% inflation target. Moving forward, the emerging debate for 2024 will be the clarity of the Fed and other central banks' interest rate trajectory. This will determine the pace, depth, and the volatility of readjustment in global rates. From a regional government bond perspective, we remain overweight Indonesia as you expect total returns of 7% in 2024. We remain market weight for Malaysia as we expect a total return of 4% as the current yield curve is close to its historical trend. We are also market weight Singapore given our expectation of a total return of 3.4%. For Thailand, we remain underweight with an expected return of 3%. Our end 2023 10-year US Treasury and 10-year MGS targets of 5 and 4.1% materialized on 19 October when the 10-year US Treasury closed at 4.99, while the 10-year MGS closed 4.159 a day later. Given our expectations for the OPR to be maintained at 3% throughout 2024 and 2025, we expect the 10-year MGS to trade around 3.75. We continue to overweight corporate bonds versus government bonds, as credit should outperform rates given ASEAN banks are already at neutral policy rates, will mean nominal returns, and constructive regional economic outlook should keep credit quality intact. The expected normalization of global bank rates by the end of 2024 will be conducive to duration. As such, we think duration will continue to perform well in 2024. Our top corporate ringgit bond recommendations are IOI Properties Group, Lebuh Duke Fasa 3, Global Agri Resources, SP Setia, Sunrise, IGB REIT, Runhill Powertron 2, MBank, Malaysian Resources Corporation Berhad, and Genting. Finally, from a balance of risk perspective, the high interest rates could weigh on US and global economy, leading to a hard landing, aka a global recession, which could trigger a rapid fall in inflation and interest rate, which will benefit government bonds. So, that's all we have for this episode, and thank you for tuning in, and see you at the next podcast.